Hello and welcome to our end of July update from the Wealthy Doctor Institute. Intelligent Investing for the Busy Professional. We focus on simple, battle-tested methods of investing that require just one adjustment each month to protect and build wealth. I'm David Yeh, author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and adjust each month, for those who are new to the concepts of this book, or for those who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So for this month, we'll cover the topic of the month, review the 20-month moving average system, review the adjustment for the MRI system, and then touch base on the 25% stop loss system that we use for stock tips. And then, since we introduced Sector Server, just a reminder to mind your portfolio on Sector Server if you have one. So from our May video, we left off talking about the difference between what would happen if we were to spend all cash versus taking out a loan or mortgage and spreading out payments over time. Now, I've gotten some questions about this, all fair, and let's analyze this a little bit more in depth. So, just to refresh, we're investing, returning roughly 8% per year, every year, and we're adding $1,000 per year, every year to our hypothetical account. Now, realize that this is a hypothetical situation. If we were to actually use an investment that returned roughly 8% average per year, it would not be a smooth growth curve like this. It would be more jagged with ups and downs, some years doing better, some years doing worse. That's just the nature of the markets and nature of investing. But again, for illustration's sake, if we were to have invested this way and spent money at year 15, we'd end up with $29,000 versus if we were to take out a loan and stretch out the payments, even with interest, we would end up with $37,000. Now keep in mind, every year we're putting away $10,000 into our accounts, but we're spending $2,600 per year. In other words, if we were to stretch out our payments, we're actually net taking away from our accounts. So that's important to know. So what's the implication of that? Now here's an example of if we started loan payments at year 15, yes, there's enough critical capital mass where if we start deaccumulating, in other words, withdrawing money, we still have enough of critical capital mass to make up for a shortfall. But if we were to have started 2 years earlier, we would have been net decreasing our account. And if we were to start 2 years even earlier than that, it would have been devastating enough that we would have become negative at year 27. And obviously, if we start at year 0, putting in $1,000 but taking out $2,600, we'd be deeply in the red really quickly. And unfortunately, a lot of us who have student loans were already hobbled by this mortgage-sized loan before we even start having any substantial income. So, life balance and financial balance. Let's talk a little bit about this. People have been asking me, well, what am I saying? Are you supposed to save, and invest? You're not supposed to spend anything at all? Well, that's no fun. I mean, intuitively, you think, yeah, you have fruits of your labor, and you should be able to enjoy your fruits of your labor. Otherwise, it's no fun, and when there's a habit that's no fun, people tend to not stick with it. So there is that balance of enjoying something now and still being able to save for the future. So we have some rules or guidelines that we can follow. And the number one rule guideline that you're going to read in any of these financial planning or personal finance books is spend less than you make. Well, that's true, and I've shown you the exception to a rule is that if you have enough of a critical capital mass to be able to start spending and still have money working for you, stick with this rule. And of course, one easy way to spend less than you make is to pay yourself first, then spend the rest. Spending is kind of like one of these laws of nature. Like, for instance, gas fills up the volume that's allotted to it, or work fills up their time allotted to it. Budgets or spending tends to equal or sometimes exceed the budget allotted to it. So we can trick ourselves into spending less by paying ourselves first and spending the rest. And make sure that when you have a spending plan, I don't want to say budget because budget is psychologically distasteful. We like to use spending plan. Make sure that you have a spending plan. It includes an emergency fund. And then rule 2, dealing with large purchases. So here's some guidelines dealing with large purchases. Large purchases can be, for instance, mortgage, kids' education, investment opportunities that come along. At least you have something that you can immediately jump on it. Emergencies, and of course goals and dreams. And don't forget retirement, the ultimate large purchase. Everything else before retirement, at least if you spend, you still have that backup of your paycheck to mitigate the expense of any of these other large purchases. But once you get into retirement, you no longer have that paycheck seatbelt. So let me explain the 3-bucket system. There are many systems out there. I'll use this one just because it's in a book that I'm sure many of us are familiar with. It's a bestseller that just came out. And the 3-bucket system consists of, when you pay yourself first funds, you have a bucket called the security bucket. Security bucket is something that you use for emergencies or for fixed short-term goals. Then you have the growth or risk bucket. And the reason why we say risk bucket is because security bucket, we're thinking about assets that cannot lose value, such as cold hard cash, although arguably inflation loses value over time. Bonds, if you don't sell them when interest rates spike. Certain insurance products, such as whole life insurance or annuities. But then, by definition, investment is otherwise risky. There's always a chance that you could lose money. That's why we call it risky. But that's also a place where we tend to get most of our growth. And then, of course, we have our dream bucket, the importance of having rewards. And the rewards can be anything from champagne for date night, end of the week, or saving up for the island that you like to buy eventually, or funding your values, feeling your gratitude when you contribute to charities of your choice. The point of the dream bucket is, if you concentrate on only bucket 1 and 2, where you're saving, investing because you never think there's enough, well, you can be millionaires and rich by any other standards, but you still feel poor and cheap. But other people, they have the exact opposite problem. They overfund their dream bucket. They buy these vacation homes and fancy cars now, and they severely underfund the security and growth buckets, and they're in trouble when it's time for retirement. So, financial life is a balance of these 3 buckets. Having said that, let's start looking at our systems. Our first system is a 20-month simple moving average system. The rule is, if the price of the S&P 500 index is above the 20-month moving average, it's relatively safe to stay invested in the index fund. Otherwise, get out. The 20-month moving average is our safety belt. It only works if we watch it every month. So here's a graph of the S&P 500 index fund. The one I'm using is the Vanguard VFINX. That's a ticker symbol. The only reason I use that is because we have a lot more data that I can use to show how it works. And if we take a look, the VFINX price as of the end of the month is $200.79 per share. And our simple moving average is 188.15. So just a quickie math, you have 6.7% cushion. In other words, the index grows, stays the same, or drops less than 6.7% by the end of next month, we stay in next month. Otherwise, if it drops more than that by the end of next month, but not during the middle of the month, we get out. So observations, the more time we have in between trades, the larger the probability of growth. In other words, we don't like whipsaws. We've had 2 so far within the last 15 months. No whipsaws this month. Whew. So here's our next system. It's a completely different system. It's the MRI system, the monthly rotation investment system. The rules for this one is that we have 3 mutual funds, not just 1, 3. The S&P 500 Index Fund, the Emerging Markets Fund, and the Inverse S&P 500 Index Fund. What we do is every month, we rank all 3 funds, sell the bottom 25% of our portfolio, and buy the top fund. So this is how we did this month. Here's last month's values, this month's values, divide, and we have a clear winner. The emerging markets is up 4.7% versus the index fund at 3.7%. And you can see this graphically here. The emerging markets did fall a little bit during the first week, but then shot up. The S&P 500 index didn't fall as much, but then it didn't show up as much. So right now, the dominant fund continues to be the emerging markets. And of course, if the index fund goes up, the inverse fund by definition goes down. So last month, we were half in the emerging markets fund and half in the index fund. If we were to sell the bottom 25%, which 25% of our portfolio's worth of the index fund, we would buy the emerging markets fund, and we would be roughly 3/4 emerging markets fund, 1/4 index fund. So observations for this month. The markets have been moving up this month. Now, we can speculate all we want with all the uncertainties in the markets, with everything that's been going on overseas, as well as the election year, what's going to happen next month, but let our system tell us what to do. Don't second guess what the markets will do. Just follow the system. And so far, the emerging markets have been the dominant trend. So the next system is the 25% trailing stop loss system. I'm only going to touch base on the rules. I don't know which stocks you've bought. I don't know which stocks you're in love with. Don't fall in love with stocks. Be strict with your rules. So in other words, if you really want to buy a stock, limit risk to just 1% of your portfolio or trading account by buying only up to 4% of your trading account's worth of your stock, and enter a 25% trailing stop loss order. If the stock goes up 33%, buy another block of stock using another 4% of your account. Otherwise, if you stopped out, just sell if it's not automatically sold. And then again, here's another system that I'll just touch base on. We introduced this last month. It's sectorsurfer.com. For those of you who have set up Sector Surfer accounts, you probably know that the StormGuard armor did kick in last month, and the signal is if you're using StormGuard armor with the Sector Surfer, you're probably in your bond fund or cash, depending on how you've set up your portfolio. Remember, your systems are your systems. All I'm doing with this video right now is just reminding you, periodically check it. Just because even though you can program it to send you alerts via email or text, just in case your email doesn't get through or your text doesn't get through, I check it at least once a week, but that's me. So in summary, remember, we have different systems. They all mitigate market risk differently. Don't mix up these systems. Don't mix up the rules of these systems. If you combine rules, you no longer have a system. So remember, you have a 20-month moving average system, which is different than the MRI or the monthly rotation investment system, which is different from dealing with stock tips, with a 25% trailing stop loss system, which is different from your sector server strategies. If you're investing, it's a great idea to diversify by system. And it's also a great idea to at least monitor at least once a month, if not once a week, for something like sector server and your trailing stop loss system. So questions, keep those questions coming. I know I talk to several of you personally each month, but for those of you who have only heard about me indirectly, maybe you got a copy of this video forwarded to you by a well-meaning friend or colleague, here are ways to get in touch with me. Drop me a line, give me a call, email me to set up a consult. A few of you who I've talked to, you know your stuff, you're fine. I don't have to worry about you. But for some of you, holy cow, it's clear that you need help getting your financial life in order. Don't be bashful reaching out for help. The more you delay, the more time is against you. So until next month, invest safely